Hi, everyone. Thank you so much for joining me. My name is Fawad Razaqzada, market analyst with Think Markets. And you're joining me from London, working from home at the moment. So please ignore any background noises that you might hear because my one of my kids are here at home, but in the other room. Hopefully, she won't wake up in the next half an hour while I'm doing this webinar. But if she does, I do apologize in advance. Now, usually my colleague Victor joins me in this webinar. He's more of a macro analyst than myself, and he has very interesting perspectives on the markets. But today, he is unavailable, so you'll have to bear with me. So let's begin by welcoming you to today's webinar. Thank you so much for joining me. If you are watching this on YouTube or elsewhere, please make sure to join us next time, because you will have the opportunity to ask me questions live. So for those of you who are here today, please feel free to ask me any questions about any markets that are tradable with Think Markets, and I'll be more than happy to provide an analysis on those markets. So basically this webinar is meant to be live analysis and very interactive as possible, as much interactive as interaction as possible with the attendees in this webinar. So please don't be shy. I do have a couple of markets that I will go through in a minute or so when I share my live charts. But before I begin, please read the risk warning or the disclaimer right in front of you. And I'm going to start off by reading the first paragraph with you, and then we will begin the webinar. Okay, so these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investments based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Okay. So just a quick reminder for those of you who are new to this webinar, it happens every Tuesday, 11:30 London time. So it's mostly on technical analysis of major currencies, gold and indices. We do touch on the fundamentals as well. So, if you do like your fundamentals, it's not going to be too much in this webinar, but we do touch on them. We have a Q&A at the end. Okay, so let's just jump straight to the charts. And hopefully you should be able to see my chart, the euro dollar chart in front of you. The reason we are looking at the euro dollar today to start off with is because it's a bit of a risk-off day in the markets. Although stock indices were down only slightly this morning, there has been a relatively sharp reversal in risk appetite for other assets, including currencies and crude oil, which took a battering today. So we've seen travel and leisure stocks, as well as a few miners, being among the weakest this morning. And FX traders have moved into safe haven Japanese yen and US dollar and out of growth sensitive commodity dollars, as well as the euro and also the pound. So why is it risk off today? Well, a number of reasons, but mainly because of fears that lockdowns are here to stay longer than expected. So previously, people were expecting lockdowns to end by around the second quarter to the middle of the year, but it looks like now they are paring back some of those excessively optimistic growth, those projections about the end of lockdowns. Investors are realizing that although there might be light at the end of the tunnel, it is proving to be an extremely long tunnel, and we are still nowhere near the end of it. So we've seen a surge in virus cases in mainland Europe, where the rollout of vaccines has been painfully slow. And this has cast doubt on the resumption of travel in the region. So this is why the German government has decided to extend the nation's lockdown until 18th of April. and it will be Germany will be in almost complete shutdown over the Easter holiday period, as they try to defuse another wave of COVID infections. So, among other things, this is really hurting demand projections for crude oil and holidays, which is why crude oil has fallen sharply today. I'll touch on crude oil later on, but I'm going to start off with the euro. And before I show you the euro, let me quickly show you the bond yields. This is the German 10-year. As you can see, it's fallen quite sharply today. This is a daily chart of yields. Recently, yields have been going up because people were expecting the Eurozone economy to reopen soon. And that was providing lots of pressure for gold and other lower yielding assets, and providing support for value stocks. But as you can see, over the last 3 or 4 days, there's been a reversal in yields, and this is putting a lot of downward pressure on the euro, especially against haven currencies like the Japanese yen. But yeah, going back to the euro dollar chart. So as a result of everything I've just mentioned, from a macro point of view, you can see that the euro dollar has been struggling really for since the turn of this year. It has broken its bullish trend line. The euro dollar has moved below the 21-day exponential. This is the red line is the 21-day exponential moving average. Okay, so let me just write that down. There you go. With the euro being below the 21-day exponential, the short-term trend is clearly no longer bullish, and price is continuing to trade inside the bearish channel. So the path of least resistance, therefore, is to the downside as things stand. And where do we go from here? For those of you who were here in my previous webinar, we mentioned this key resistance zone, this shaded region, previously resistance and support. I said for as long as we hold below that, the path of least resistance remains to the downside. And as you can see, not a lot has changed. So my bearish outlook remains intact for now. I think it looks very likely that the euro dollar will touch the 200-day moving average as a minimum, but potentially it could fall further lower, with 1800 or 118 handle being the next downside target, which is just ahead of the trend, the lower trend of this bear channel. So to be precise, the channel comes in at around, the support trend of the channel comes in at around 117.80ish to 117.70. So slightly below the 118 handle is where the next key level of potential support may come in. But if that level then breaks down, then it's really anyone's guess how far this could fall. With liquidity below 116, this double bottom low here being the next obvious downside target for the bears to target, because just below that we have the key 115 handle right here. So it's a bit early to say for sure if the euro dollar is going, well, you can never say for sure, right? With a degree of confidence to say that the euro dollar is heading down to 115 from here. But let's see if the previously mentioned support levels break down, then it could pave the way towards a potential and an eventual drop to 115 handle over time. So that's my kind of longer term objective. We are still about 350 pips above 115, so some distance to go for the euro to get down to that level. So that's the downside target. In terms of upside, it needs to clear this resistance area, as I mentioned, before we talk bullishly about this market. And if it does clear 120 again, then it will most likely go on to retest the resistance trend of the bear channel, which comes in at around 121 as things stand. Obviously, it depends on when it will get there, if it does, to be more precise about the exact level of the resistance trend of the bear channel. So that's the situation with the euro dollar. It looks bearish at the moment. I think more downside should be expected. I did share a long-term chart to my on my personal Twitter handle. Let me see if I can find that one, because I feel that no, it's not here. Anyway, I'm gonna draw it again on this. It's a really interesting pattern that I have observed. So previously, this is what I was expecting the euro dollar to do. Okay, so I was expecting the euro dollar. This is the weekly chart to do something like this. You know, to follow what price did in 2017 and early 2018 when we had a big up move, a consolidation, and another leg higher. We had a big up move in 2020, consolidation towards the middle of last year and the latter parts, and then a breakout as we headed towards the year end. Very similar to what had happened in the past. But although it looked like it was going to take out the 125 handle, things have changed from a macro point of view. So now I'm thinking that you know, the euro dollar has completely or completed this fractal that it was following previously. And so if I draw a couple of boxes to show you what I mean now, just bear with me 1 second. So we had this big up move, yeah. We already had that over here. Then we had some consolidation around this zone. Let me just color that in, I don't know, green. Similar to here. Then another up move, and then a consolidation here. So this consolidation is very similar to what happened here. And then following that consolidation, price starts to break down, breaking below support, like this level here. You see that? It broke below it, and then it went down quite sharply. And it looks like that level is around 120 in this case here, and we are below it now. So could the euro dollar do something similar to what it had done in the past and head sharply lower? You know, you can't rule it out at this stage, especially with US yields rising at a faster clip than the German bonds. You know, the euro dollar could potentially fall sharply from here. So that's something to watch out for. In terms of other euro crosses, the euro yen looks really interesting. Previously, I was quite bullish on this market, as you have probably seen in my reports and previous webinars. There was a breakout from this bull flag, which I thought it was really significant, and it was leading to a sharp move up to the 130 handle. But in recent days, if I zoom in, things have changed. So let me just clear this up a little bit. Firstly, notice that the trend has come to at least a short-term pause around the 161.8 Fibonacci extension of the downswing from here to here, which was the last significant move down. So price was already at an exhaustion point, but more to the point, it was also testing this 130 handle, which was a key support and resistance level in the past. If you look at your historical charts, like this one, for example, the weekly chart, 130 has been pivotal. Yeah, now you can see it more clearly. You can see that it's been very sensitive to price. Every time it tested that, it either rallied sharply, or once it broke below it, it fell quite sharply. So here we are again at 130 handle, and what happens next is going to be very important in terms of at least near-term direction. And judging by going back to that weekly chart, last week we printed our first bearish candle in 5 or 6 weeks, and on the daily time frame there was a bit of a breakdown, with rates going on this particular day. It looked quite bullish, didn't it? It looked like it was going to take off, but on the very next day it tried to break above the 161.8 extension, and it then dropped back to close below the 130 handle, and that was the turning point for me, right? So now what has happened is price came up to retest this level, and look how it sold off. Yesterday it gapped lower at the Asian Open. It then rallied really sharply to close the day, but again that rally has been sold into. So previously people were buying the dip in this market, but now it looks like they are selling into the rallies. So it could be a sign that things that the long-term trend has potentially turned. So going forward, how do you trade this? Well, I think that, let me just draw another thing here as well. There was a short-term bullish trend line somewhere here, which has also been taken out. Yeah, so with this trend line being taken out, the longer term bullish trend line comes in at around 127.5-ish, yeah, or thereabouts. I think there's a potential for rates to drop to this trend line before deciding on its next move, which could either be a resumption of the long-term trend, or a big breakdown and we head down towards 125s. So keep an eye on the euro yen in the next couple of days, as it could provide lots of good trading opportunities in my view. So that's the euro yen. I can't see any questions, guys. Please ask questions if you have any. And I'll be more than happy to talk about that particular currency pair that you are looking at as well. Before I move on from FX, let's look at the dollar CAD. This is a bit outdated, this chart. Let me just clear things up. The dollar CAD has been in a strong bearish trend, as you can see. This is the daily chart. However, recently, what happened is we have had a nice bounce off the lows. It remains to be seen whether this is the start of a bullish trend and an end of the long-term bearish trend, or whether this is yet another short-lived recovery attempt in the dollar CAD. I think the dollar CAD could be heading higher because we have seen the US dollar, make sharp gains against other commodity dollars like the Aussie dollar and the Kiwi dollar, and so the Canadian dollar could be next. Last week it created, I think it was on 18th of March, I think that was on Friday, wasn't it? No, Thursday of last week, it created this bullish engulfing candle, which pushed price back above the previous low, this low here, thus creating a possible false breakdown scenario. And the fact that we have held above that level so far this week, it is certainly a bullish sign. But we do need some confirmation. So a confirmation could be a daily closing break above this bearish trend line that has been in place since March 2000. I'm sure that was March 2020. Yeah. So that trend line has been in place since March 2020. If we break above this trend line on a daily closing basis, I think that would be the confirmation that the bulls are seeking at the moment. So watch out for that potential bullish scenario. I mentioned the Aussie dollar and the Kiwi. The Aussie dollar is looking somewhat more bearish than it did a few weeks ago. It has already broken this trend line. and it's really struggling. Previously, this was my the kind of invalidation level for the bullish trend, but now it is this red level right here, because that was the last low made prior to price making the latest rally, which then broke down right here, right? So we've created a series of lower lows now relative to this low, that being the last significant low prior to price breaking out. So with price making new lower lows and lower highs, you know, the trend has turned. It's no longer bullish, and this is a channel that rates could now drift into to the downside. So resistance is at 7725-ish, which was this low here. Any retest of that level, I'm not sure if it will get back to that level. So maybe if I zoom in a little bit, we can refine our resistance levels more precisely. You know, if I select this low from yesterday, notice how yesterday we formed a hammer-like candle or a doji-like candle, and there was no upside follow through, suggesting that the buyers are getting trapped because the trend may have turned. So this region here is the key area of resistance to keep an eye on going forward, which means that if we see a possible retest of this region, we could see that rally get sold later on today or later on in the week. And the first target would be these lows here. Then below that, liquidity below this low. By liquidity, I mean stop orders below that low will be taken, will likely to be taken next. Okay. Remember, the market always moves from one area of liquidity to the next area of liquidity, and you can see those areas of liquidity visually by plotting levels at prior lows and prior highs. So below this low, there'll be lots of stop orders from people who bought that rally. Similarly, below this low, there'll be lots of stops from people who bought this rally. You see what I mean? So there will be lots of stops resting below here, which will attract, like which will act like a magnet and attract price towards it. So that's why I think the Aussie dollar is likely to hit down and take out those liquidity pools in the coming days and drift inside this channel. So that's all well and good. At what point will I be proven wrong? Well, if the Aussie were to make a higher high above this high, then at that point I would drop my bearish bias on this particular market. So a move above 78.50 in this case would be bullish, because we will have created a higher high relative to this high. The New Zealand dollar is looking quite bearish because if you look at the Aussie Kiwi first, you can see the Aussie has rallied. Big breakout here above resistance at 108.25-ish. Big breakout here today. So the Aussie is rising faster than the Kiwi, or put another way, the Kiwi is falling faster than the Aussie, which is why the New Zealand dollar against the US dollar is looking quite bearish. So these are the key levels of resistance to watch out for in case we see a possible rebound later on today. And around such levels, we could see the resumption of the downward move. In other words, the area between call that 71 to 71.40. That is the next or the key area of resistance. So if you get pullback into this region, expect a downward move to at least whatever low today's low might be. I've covered the Aussie, the Kiwi, the CAD, the Euro dollar. Now the pound is one that I'm not too sure about, okay? Because it is still the strongest currency outside of the US dollar right now. Well, obviously the yen being really strong today because of the risk reversal, but the pound has been strong owing to expectations that the UK economy will come out of lockdowns sooner than Eurozone countries, because here the vaccine rollout has been quite successful and lockdowns are being eased slowly. So right now the pound is testing the long-term bullish trend line. So although the trend line could break like the other dollar pairs, this is one market I would not actively look to short it, right? I'll be more inclined to short the euro or the Aussie or the Kiwi than the pound against the US dollar because of the somewhat bullish macro backdrop, if that makes sense. So what I'm looking for the pound against dollar is a possible reversal, a bullish reversal candle to be formed around this trend line or slightly lower than that, or for price to drift and then eventually break out from a holding pattern or the like. So this is the market I'm not going to touch on the downside. Okay, let's now move on to have a look at some of the other markets. Should we do some commodities first, and then we'll cover the indices afterwards? Yeah. Meanwhile, if you have any questions, please write them. I know there are a few of you in this room, so please don't be shy. Ask me any questions you have. I'll be more than happy to answer. Yeah, US oil. You may have seen my reports on Think Markets in recent days. Let me just show you. For example, yesterday I posted a chart, a report on the Brent crude oil, saying that Brent had broken below this low, creating a lower low, and that it could turn lower from here. Prior to that, I had also written some reports on crude oil when it was testing $70, suggesting that it could go down from there because of so several reasons why I thought oil could go down from there. One was basically easing of supply restrictions and the potential for non-OPEC supply, namely US shale producers, to ramp up production now that prices of oil have rallied significantly from their 2020 lows. The other being that demand could be hit because, as you know, lockdowns in Europe are going to stay in place longer than expected. So there's a question of demand. There's a question of supply. Both of those to me look like, and also most of the positivity I think is already priced in on crude oil. So from around current levels, I can't see how oil can go significantly higher than where we are at the moment. Yes, it could go and reclaim 70, but I honestly can't see oil remaining above 70 for too long. Sorry, that's the Brent crude oil. Here we're talking about the US crude oil. Let me show you Brent first, and then we'll talk about WTI. So this was the Brent chart I had shared yesterday. It held resistance around 64.70. The reason I was looking at that particular level is really simple. So if you zoom in, you can see that level was, imagine, you hadn't seen price action that had unfolded after it reversed at 70. That level was really the point of origin of the breakout from this continuation pattern, right? This triangle pattern. So once price breaks out from a particular continuation pattern, usually the retest of that level holds in a strong trend. So what happened here is, as you can see, oil sold off I think it was last Thursday, and it took out that level without even pausing there. It may have paused on the lower time frames, I don't know. But on the daily, at least, it didn't pause there, and it went on to take out the previous low. So that level, which should have turned into support, didn't. It's likely that people were sitting on the bids at that price, bidding the market up if it got there. But the fact that it didn't hold, those people will have used Friday's bounce to take to close out their positions that they had accumulated around that level. Yeah, so that was my thinking behind why this level could turn into resistance. And lo and behold, crude oil went down and it took out the previous low. So it's making lower lows, interim lower lows, and now lower highs, and the trend line has been taken out on the daily time frame. Which means that the path of least resistance is to the downside, and Brent oil could now drop to $60 per barrel next, but potentially a lot further lower if things turn ugly from a macro point of view. The longer term trend is way below market, so there's a possibility we could see a deeper correction in the coming days and weeks. So if oil goes down, this could boost the dollar CAD, because if the Canadian dollar falls, Canadian dollar usually tracks oil prices because crude oil is Canada's largest export commodity. So that's why I was looking at the Canadian dollar earlier. So if oil goes down, as I think it might, given what's happened this week and last week, then the Canadian dollar could be heading lower from current levels, meaning that the dollar CAD pair could rise, right? US oil. Now, WTI has also broken its trend line. Very similar price action to Brent. The level I was talking about on Brent, this level here at 64.70. The corresponding level on WTI was at 62. Notice how that level has turned into resistance, leading to a breakdown. So going forward, where's the next level of resistance? Well, the next level of resistance is going to be, or it should be, the low from Monday, which is at 60, just above the 60 handle. So if we do see a rebound in WTI, then a possible resistance zone could be around here. So I've selected this low and Monday's low and shaded that region between it. So the area between 59.27 to 60.38 could be the next major resistance zone to watch out for. Yes, it's a very wide range. Usually I'm more precise than that, but on this time frame, those are the two key reference points that I'm using. But if you obviously zoom into your lower time frames, you might get a more precise level of resistance on this time frame. On the lower time frame, on the hourly, this particular level looks quite interesting at 60.30, which was, I think that's the level I'm talking about. Yeah, on the daily. That level looks very clean, doesn't it? Previously, it was support, nice clean breakdown here. So if we get a pullback, then I would expect some sort of reaction from that level. The key objective or the short-term objective for this downward move will be liquidity resting below this low at 58.20, because that's where trapped longs stop orders would be resting. People who bought this dip, some of those guys will have placed their stops below this recent low. So if the price of oil continues to go lower, then it's very likely to take out those stops before deciding on its next move. I'm not saying that oil will necessarily stop there, but that's the first downside target. Okay, as you can see, there's not much further support until this level here on WTI. Call that 53.50. This level was previously resistance, 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 and then we broke out. Never retested it, so it remains exposed for a potential retest. Will we get there is another question, but I'll leave it out there for now. What about crude gold? Well, I'm not too sure about gold, to be honest. I thought it might break down more decisively following the FOMC decision, which caused US bond yields to go up. That should have pushed gold down. It didn't. And in recent days, I showed you earlier, yields in Eurozone at least have fallen. This is the 10-year German yields. This is the 10-year US, also gone down. So when yields go down, the opportunity cost of holding gold goes down as well. Yeah, which means that gold would find support, everything else being equal. But the fact that the US dollar has risen is kind of counteracting that move lower in bond yields, which is why gold, which is denominated in US dollars, has struggled to make a more precise move or more decisive move in either direction, because the recent falls in yields have been offset by a rising US dollar. So I'm not really sure which direction gold is headed, but it remains inside this large bearish channel. And previously, this is the level I was expecting it to get up to and then sell off. It didn't quite get there. And how it's approaching this resistance area is kind of making me worried if I was a bear on gold, because normally I'd like to see a sharp move into the prior support, which should then turn into resistance. But because gold has drifted higher, it means that even if it gets there, and if you do trade it short at around that level, your objective would not be somewhere here. It would be the first area of trouble. The first area of trouble in this case would be very close to where you might enter around this shaded region, right? It would be around current level prices or slightly higher, where prices consolidated in recent days. So in other words, there's not much meat for a short setup around this 1760 to 1765 area for me to consider. But anyway, we shall see. In any case, I will only turn bullish on gold if it makes a higher high above the most recent high, which was here at 1816. If it takes out that high, then the path of least resistance on gold would be to the upside again. But for now, I'm not sure. It is worth noting that gold has bounced off of a key support area. Actually, I'll show you on the daily. As you can see, I have marked this level out, this high here. This was the March 2020 high. In other words, the high that gold made prior to the first lockdowns. So that level, once strong resistance, has now turned into support. In addition, we have the 61.8 Fibonacci retrace of the last upswing from 2020 low to August 2020 high. The 61.8% retracement of that, converging with the pre-pandemic high and the support trend of the bearish channel, has all helped to provide some support for gold in recent days. But where is it going is the key question, and to be honest, I'm not too sure. This is one of those markets where I'd like to see more price action before providing a more confident analysis on. So we will leave gold as that. I'm just looking at the time, guys. I have gone over by like 10 minutes. I am happy to continue, but I will need you guys to ask me questions now, if you like to, or if you have any questions. So please don't hesitate. If you do have any questions, I'll be more than happy to spend about 5 minutes on those questions. So yeah, don't be shy. In terms of indices, yes, it's been a bit of a bearish day for crude oil and in the FX markets, but the major global indices are still showing no significantly bearish signs yet. Will that change? We shall see. But the German DAX index is still hovering around the 161.8% Fibonacci extension of the last downswing. In other words, it's trading near the all-time highs. And the daily candles show not much movement as I zoom in. The S&P 500 is starting to look a little bit tired at these levels. Yeah. What do I mean by that? Well, look how overextended the rally has been. Yeah. And although it's kind of clinging on to this support, it did kind of break below it. This trend line, I should say, it did break through it a couple of weeks ago, before reclaiming it. But more to the point, this high here was the last high, the last record high. It rallied sharply to get to that high, but then it really struggled to stay above. So for as long as it holds below that trend, that level rather, there is a possibility we could see a retracement of some sort. Similar picture for other indices in the US. The Nasdaq has been one of the weaker performing current indices in 2020, owing to the rising yields. But today yields have fallen, so Nasdaq would naturally rise because of that. In any case, it needs to break through this red line here to create a bullish structure, because right now it has been forming lower lows and lower highs. So the key level of resistance that needs to break from a bullish point of view is at 13,300. In terms of support, we have 12,750 as a key level. You can see the index forming a possible reverse head and shoulders there, with the left shoulder being here, the head here, and the right shoulder being here. However, if it breaks through this level, then that would be quite bearish, because it will invalidate this inverted head and shoulders pattern. Guys, I have run out of time. Thank you so much for joining me. I can't see any questions, so thank you so much. Be careful out there this week. Make sure to join me again same time next week. And for those of you who are watching this on YouTube, how you could join me is well, it's quite simple. You go to to our website, thinkmarkets.com. You then go to market analysis, scroll down to live webinars, and here you will see a list of the upcoming webinars. And the next one will be March 30. which you can register for by clicking on this button. Okay, thank you so much. I'll see you guys next time. Take care. Bye-bye.